Hey guys, welcome back to my channel. If you haven't already done so, go ahead and like, subscribe, and leave a comment of any content you'd like to see below. So today I decided to talk about long-term and short-term capital gains and losses per request of one of the comments. So typically speaking, a short-term capital gain or loss means that you purchase some kind of security, so a stock or a bond, within the time span of a year, defined as not necessarily 2019, 2020, or 2021, but from whenever you purchased the stock. So if I purchased a stock, say today, December 18th, 2020, and I held on to it until May 20th, 2021, I would not have held on to that stock for a full year because it's less than 365 days. Therefore making it a short term capital gain or loss depending on when I get for selling it. Now, a long-term capital gain or loss, as you might have guessed, is the opposite. So if you've held on to a security that you purchased for more than a year, so more than 365 days, and decide to sell it, then it's either going to be a long-term capital gain or a long-term capital loss. And as you can see as well, they both have different tax rates. So a short-term capital gain or loss is taxed at anywhere between 0 and 37%. So don't be alarmed by the percentages you see here. This is just the regular tax table because the IRS views short-term capital gains as just ordinary income, meaning just it's counted as regular income as anything else, and it doesn't have a separate tax category or a tax rate than your regular income. So if you get taxed at 27%, your short-term capital gains are going to be taxed at 27% as well. Now, if you have a long-term capital gain or loss, and ideally this is what you're going to want to do, is hold on to whatever securities that you have for at least a year before selling them, because you'll most likely qualify for a lower tax rate. So you can get taxed at either a 0, 15, or 20% tax rate. And again, there are exceptions to these rules for specific types of assets and different types of exemptions. But in the overall gist of things, and just kind of in the interest of being broad in general, these are the overall rules. So let's say that you sold stocks this year for $10,000. So you got a $10,000 gain. And throughout the year, you also sold stocks at a loss and you had a $3,000 loss. What ends up happening is that these two get netted against each other and you end up with $7,000 of capital gains. So this is $7,000 of regular income that's going to be taxed at whatever your tax rate is in the tax bracket. So this tax bracket. So it's just going to be added to whatever your adjusted gross income is and taxed at that rate with everything else. Now, let's say the same thing happened. Let's use the same example over here for long-term capital gains and losses. So you had $10,000 of long-term capital gains and $3,000 of long-term capital losses. Now, you're going to have $7,000 that are going to be taxed at one of these three tax rates above here. So this is going to be taxed at a separate rate than the rest of your income. So this $7,000 is going to either have 0 tax, 15% tax, or 20% tax, depending. And this depends on also separate types of brackets. I don't know the exact figures, but the ballpark was generally $0 to almost $40,000. You would not have any tax at all on the 7,000. Now, if you fall between 40,000 and I believe $244,000, you would be taxed at this 15% rate. And if you made anything more than that, you'd be taxed at the full 20%. And again, there are exceptions, such as like if you have rare rocks like gold or silver that you sold, or art or collectibles, those typically get taxed at a 28% rate and they have their own rules. which I'm not going to go over right now because they get a little bit convoluted and complex. So this $7,000, let's assume for the average person, is going to be taxed at a 15% rate. You're always, for the most part, going to want to hold your stocks for at least a year before selling them if you're expecting a gain. So if you're expecting a gain, you might want to hold on to it for more than a year just so that when you do decide to sell it, you're taxed at this low rate rather than something in the 20% range over here in the short-term capital gains area. So let me know what your thoughts are on the topic below in the comments. If you have any additional content that you'd like to see on this channel, go ahead and let me know. Go ahead and like, subscribe,